Okay, we need to dive right into this because something absolutely wild and honestly, largely ignored is happening across the Pacific right now. If you track the 30-year US bond yield against the 30-year Japanese bond yield, you'll see the gap between them is shrinking incredibly fast. It's like a ticking clock. The second those two lines cross, well, that has the potential to wreak absolute havoc on the US bond market. And since the bond market is basically the gravity of our entire financial system, dictating everything from the broader economy to the stock market, this convergence is probably the single most overlooked threat in global markets today.
Welcome to This Explainer. I am so thrilled to have you here. Today, we're mapping out a massive macro domino effect that's already in motion. We're talking about a once-in-a-generation financial reset, and it's all being driven by a profound shift in Japanese economics. By digging into the data, we're going to see exactly how a policy change thousands of miles away could fundamentally alter your day-to-day economic reality.
All right, Section 1, the unseen financial threat.
So, let's introduce the very first falling domino here. To really grasp the threat to the US system, we have to pivot our focus entirely to what's happening on the ground in Japan. And it all boils down to one number, 4%. The yield on a 30-year Japanese government bond just hit 4%. Now, that is a huge deal because it's the highest level since this specific bond was launched way back in 1999. I mean, it's nearly doubled in just the past year alone. For a market that has essentially been asleep for decades, suddenly doubling your yield, that is a roaring siren.
So you might be wondering, why on earth does a 4% yield in Japan matter to us sitting here in the United States? Well, it matters because of who holds our debt. Japan is by a mile the single biggest foreign owner of US Treasuries. We're talking over $1.2 trillion of American debt. For decades, Japanese investors have been incredibly reliable buyers of our bonds. But, that loyalty wasn't charity, it was just math. American debt simply yielded way higher returns than Japanese debt. So the stakes here are literally enormous. If Japanese yields start to rise, the entire incentive to hold US debt completely flips.
Moving on to Section 2, Japan's decades of deflation.
To understand why Japanese yields are suddenly spiking now, we first got to look backward and understand why they were kept so artificially low in the first place. It's a 2-decade-long economic anomaly. Japan's government carries the single heaviest debt load in the entire developed world. Their debt is over 200% the size of their entire economy. Now, on paper, a debt pile that astronomically huge should have triggered a massive debt crisis years ago. Usually, private investors see that kind of risk, demand tanks, and bond yields violently spike. But that didn't happen in Japan. Why?
Well, this perfectly illustrates how they sidestepped that crisis. For most of the last 30 years, Japan experienced exceptionally low inflation, or even outright deflation, and that set up a very specific cycle. Because inflation was practically non-existent, the Bank of Japan, the BOJ, was basically free to step in and relentlessly print money. They took that newly printed money, bought up their own government bonds, and effectively replaced private investors. All of that artificial buying pressure kept yields totally suppressed year after year. Actually, it gets crazier. At its peak, the Bank of Japan actually owned more than half of all Japanese government bonds in existence. Half.
Which brings us to Section 3, the inflation tipping point.
Because right now, the rules of the game are being completely rewritten. We've hit a critical paradigm shift where this historical strategy just completely falls apart. Look at the contrast between these two eras. Pre-2024, it was all about printing money to buy bonds. But post-2024, it's a whole new world. We're seeing a generational return of inflation in Japan. And because of that higher inflation, the Bank of Japan is now being forced to stop the printers. They've had to completely abandon their policy of pinning yields down, and as a result, they're actually reducing the size of their balance sheet pretty aggressively. So with the central bank stepping back, lo and behold, Japanese bond yields are naturally spiking.
Now, I know some economists out there think recent dips in inflation mean things will just revert to the way they were for the last 20 years, but the underlying data tells a very different story. The Japanese Import Price Index, which tracks import costs and usually leads the overall inflation rate by a few months, is indicating that inflation in Japan might actually be gearing up to turn higher again soon. So the takeaway here is absolutely crucial. This is not a temporary blip. Japanese bond yields are very, very likely to keep climbing from here.
Let's look at Section 4, the trillion-dollar exodus.
You see, this internal policy shift in Japan, it's not staying in Japan. It is acting like a massive financial gravity well, pulling vast amounts of capital completely away from the United States. To really wrap our heads around this, we need to talk about real interest rates. Simply put, this is your interest rate adjusted for inflation. And it's one of the most powerful forces in all of finance because real interest rates literally dictate where the world's money wants to live. For years, Japan's real interest rates sat below zero, way lower than in the US. So trillions of dollars flooded out of Japan, searching for better returns in American Treasury bonds. But today, wow, real interest rates in Japan have now officially surpassed those of the United States.
This means the Japanese consumer can suddenly earn a higher real return just by keeping their money at home. And we are already seeing the devastating real-world consequences of this shift. Get a load of this staggering number, $30 billion. In just the first 3 months of 2026, Japanese investors dumped almost $30 billion worth of U.S. bonds. If real interest rates in Japan keep rising, the incentive to deploy capital at home instead of abroad just drastically increases. And that, my friends, causes immense selling pressure on U.S. Treasuries.
Which leads us to Section 5, a return to the 1970s.
So what does this actually mean for you? Let's bring this domino effect right to your front door. If enough foreign investors rush for the exit all at once to head back to Japan, U.S. bond yields are going to spike. That means the U.S. government has to pay more interest on its national debt, sure, but you'll also feel it every day, like seeing your mortgage rate shoot up right alongside it. This timeline paints a really clear, if pretty sobering picture. The impact of Japan on the U.S. market is rarely a sudden crash, it's structural. Back in the 2010s, structurally low yields in the U.S. were propped up by Japanese money flooding in. But as of 2024, the BOJ is reducing its balance sheet. And now, moving into 2026, we are beginning to see the start of structurally higher U.S. yields. The last time the U.S. dealt with structurally higher bond yields like this, that was the 1970s, a period that triggered a brutal, grinding decade of stagnation for both the everyday economy and the stock market.
Now, in light of all these turbulent shifts, it's worth noting how the research firm behind our source material is approaching this. They state their mission is to generate higher returns for clients regardless of this new macroeconomic environment. They specifically pitch a proprietary quant strategy, using real capital, that they report has yielded a 468% return over the last 5 years. According to them, that's about 8 times more than the S&P 500 index over the same period. They're presenting this as their specific solution for navigating the structurally higher yields and potential stagnation we just talked about. And that really leaves us with one final, lingering question to think about. With Japan's historic bond-buying era officially over, and the financial gravity shifting back across the Pacific, are we entering a new decade of economic stagnation right here at home? It is a fundamental shift in the global financial tectonic plates, and understanding it gives you the exact context you need to watch what happens next. Thank you so much for joining me for this explainer. Keep your eyes closely on those yield trends, and I will see you next time.